You've probably heard this before. Dividend stocks are safe. Growth stocks make you rich. But here's the truth. Both can wreck you or make you wealthy. So which one's right for you? Here's what actually matters. Today we're diving into the surprisingly misunderstood world of dividend stocks and growth stocks, two investing styles that seem like polar opposites but might just be better together. Why does Coca-Cola pay you just to own it? And why Tesla keeps every penny? What's the sneaky trap that quietly bleeds dividend investors every single year? We'll also cover some common misconceptions about both kinds of stocks. Stick around, because by the end of this video, you'll know exactly how to pick your side. Or better yet, how to cheat and win both ways. Welcome to Mavic Finance, where we explain investing concepts in a simple way. By the way, this video does not contain any financial advice. Alright, let's keep it simple. What are dividend stocks? Think of them like a friend who sends you $20 every month just for being around. You don't have to do anything, they just appreciate the relationship. That's basically how dividend stocks work. When you own one, the company shares a slice of its profits with you, usually every quarter. For example, if a stock costs $100 and pays you $4 a year, that's a 4% dividend yield. Sounds small, but this dividend yield might help you beat inflation. Dividend stocks come in a few flavors. First up, real estate investment trusts. These are like landlords in stock form. They buy buildings, collect rent, and send part of that income to shareholders like you. It's like owning real estate without fixing leaky toilets. But fair warning, REITs get taxed a bit heavier, and they can be more volatile depending on the market. Then you've got consumer staples, companies like Coca-Cola and Procter & Gamble. These guys sell stuff people use every day: toothpaste, detergent, soda. Even during recessions, people still brush their teeth, thankfully. So their dividends tend to be much more stable than those from REITs. Finance companies usually pay dividends. We're talking about big banks, insurance companies, and asset managers. People need loans, mortgages, and insurance, so that steady income allows financial companies pay their dividends. Some of the most popular ones are JP Morgan or Goldman Sachs. Finally, energy sector, especially big oil companies like ExxonMobil or Chevron. These businesses spend a lot of money upfront to build things like oil rigs and pipelines. But once everything's running, they can make a lot of money, especially when oil prices go up. There are a lot more industries, but these are the main ones. Now, back to dividend yield. This part trips up a lot of beginners. A high dividend yield, say over 6% or 7%, can look super tempting. But it might be a red flag. The company may be facing some problems and wants to attract investors by raising its dividend yield. And if that company underperforms, the stock price drops, and suddenly that great yield didn't matter because your investment is worth a lot less. So, big takeaway. A high yield isn't always a good thing. You want solid businesses first, dividends second. Alright, now let's talk about growth stocks. If dividend stocks are that reliable friend who pays for coffee every month, growth stocks are the wild one who says, "Trust me, I've got a plan." Growth stocks don't pay you anything up front. No dividends, no rent checks, nothing. But that's because they're reinvesting every penny back into their business to grow faster, build new products, enter new markets, maybe even take over the world, or at least try. Think companies like Tesla, Amazon, or Nvidia. You're not buying them for income. You're buying them because you believe they'll be way more valuable in the future. If they succeed, their stock price will go up, and that's how you make money. You don't get paid along the way, but your shares become worth a lot more. Now, not all growth stocks are mega corporations. Some are small, scrappy startups with big dreams and zero profits. Investing in those is kind of like betting on your cousin's app idea. It could be the next Uber, or just ugh, so be careful with that. Also, some of the biggest companies in the world used to be growth stocks. Microsoft, even Google, they all spent years reinvesting and not paying dividends. Only after maturing did they start sharing profits. No matter what type of investment you choose, dividends, growth stocks, or anything else, there's always some level of risk involved. That said, some investments definitely carry more risk than others. The key is understanding the business behind the investment and what its future looks like. So let's move on to something that flies under the radar, but can seriously impact your returns. Tax efficiency. Don't worry, this isn't a boring tax lecture. I just want to show you how Uncle Sam quietly takes a bite out of your gains if you're not careful. If you're earning $3,000 a year in dividends, a chunk of that could disappear into taxes, potentially a few $100s every year. And if you're trying to reinvest those dividends, that tax bite adds up fast. Over 20 years, it's not just thousands lost, it's thousands that could have been compounding, quietly multiplying in the background. Still not convinced how powerful compound interest really is? I highly recommend checking out this video. It'll blow your mind. Now here's where growth stocks get the advantage. You don't pay taxes on them until you sell, so your money gets to grow undisturbed for years, maybe decades. And it gets even better. There's a way to invest in dividend-paying stocks without having to pay taxes every time a dividend is paid out, and that's through something called an accumulation ETF. This kind of fund automatically reinvests any profits like dividends back into the fund instead of paying them out to you in cash. So that money is used to buy more shares inside the fund, helping your investment grow faster over time. If you want, I can make a specific video about that. Just make sure to like this video and comment below. Based on Hartford's funds research, since 1940, about 34% of the S&P 500 total returns have come from dividends. That means roughly a third of your gains came just from staying invested and getting paid. Over decades, that kind of steady income really adds up. And some people still say dividends are useless. Growth stocks have written their own wild success story. Between 2010 and 2020, the S&P 500 soared over 400%, fueled by a massive tech boom. Amazon, Netflix, Google, Nvidia, absolute rockets. Still, keep in mind the well-known truth: past returns don't guarantee future ones. While growth stocks have outpaced others in recent years, especially in tech, that trend only holds if innovation keeps driving the sector forward. As I always tell you, it is very important to understand what you need, your goals, your timeline, and how much risk you're actually cool with. If you found this helpful, hit the like button and consider subscribing for more investing videos like this. Let me know in the comments. Are you in the dividend team, in the growth team, or even in both? If you like this video, you will probably like this one as well. Thanks for watching and see you very soon. Bye.